Hello there. Welcome to Trading Day. We're seeing some nasty selling for some of those AI chip stocks today. We'll be all over that on our show. Let's get to the big stories we're bringing you from the newsroom. NASDAQ is proposing a new rule that would allow the exchange to block IPOs, even when companies meet all listing standards, if the exchange detects red flags that could make the stock vulnerable to manipulation. This move underscores a push to tighten gatekeeping as firms from hazy jurisdictions look to tap public markets in the US, where a deep pool of capital often gives companies better valuations. Shares in cannabis companies surging after a report in the Washington Post that U.S. President Donald Trump is expected to push the government to drastically loosen federal restrictions on cannabis. The report says Trump plans to direct agencies to reclassify the drug under Schedule 3, and that would reduce it to the same level as some common prescription painkillers. And there's a look at Broadcom, down almost 11%. That chipmaker beat on revenue and profit in its latest quarter, but investors seem to be focusing on its AI backlog, which disappointed some observers, and its profit margins. The backlog of AI product orders was weaker than some analysts had expected, and the company held off from giving an AI revenue forecast. It said that total margins are being impacted right now by AI product sales. TSX earlier today did hit a record high, now under a bit of pressure to close out the week, down about 0.5%. And let's have a look at the US markets. We have seen selling in those big techs today, dragging the NASDAQ down by about 1.5%. Let's get more on the markets from Brett Ewing, Senior Financial Advisor and Chief Market Strategist at First Franklin Financial Services. Brett, thanks very much for joining us.
Thank you for having me.
What's your reaction here? We'll put up a one-year chart for Broadcom and for Oracle. Concerns seem to be centering on those two with their heavy spending. Broadcom, of course, has been a market darling.
Yes, I mean, I think we're continuing the theme here that, sell the news situation, and a little bit of the shine is coming off all of the AI trade here. And it's a massive, violent rotation into other areas of the market that we're paying attention to, and we believe will continue throughout 26.
And Oracle, in particular, took a major hit yesterday, and we did see fresh selling pressure today. There seems to be a concern that they may have bitten off too much more than they can chew. For example, racking up a debt load of more than $100 billion US.
Yeah, absolutely. I mean, transparency is coming through with all the AI ecosystems and the level of debt, the circular financing, all of that's floating to the surface. I think this is a positive for the whole AI infrastructure build out that we're seeing. This is a healthy correction within that. I think there are a lot of these companies, the overcrowding that we've seen as we went into October, that's very unhealthy and it's creating bad behavior with investors. And I think these companies need to grow into their potential earnings from AI down the road. I look at this as a positive for the entire ecosystem.
In the sense that some of the air is coming out?
Absolutely. It's a very unhealthy market as we entered into October. The breadth of the market was absolutely horrific. And since about a 4.7% correction in the S&P 500, what we've seen coming out of this correction is a very strong increase in the breadth of the market, and particular in small and mid-cap companies. And we believe that trend is intact throughout the rest of 26.
Yeah, it is interesting. The Russell 2000, as I'm sure you know, hit a record high yesterday, the benchmark of small companies.
Yes, absolutely. People don't talk about this enough, but since the big correction that we had in the market bottom on April 9th, the S&P 500 is underperforming the Russell 2000 by about 10 percentage points.
Wow.
It's a pretty significant, differential.
I guess portfolio managers, well, it's a dilemma for them, isn't it? They don't want to miss out on this AI boom. It's been so strong. In the couple of weeks that's left in the trading year, what patterns do you think we'll see? Do you think portfolio managers will be tempted to lighten up on these AI-related names?
Yeah, I think they will underperform going into the end of the year. I really do. I think there's going to be profit taking. We're already seeing the rotation. It should be going into interest sensitive assets, small mid cap companies. I think housing related stocks are going to outperform actually AI going into the end of the year and throughout 2026.
Why is that? Why do you think we'll see strength in housing?
Well, I think the market is truly underestimating how many rate cuts we're going to get. The market's pricing in maybe 2 rate cuts next year, possibly 3. I think we're going to get around 4 rate cuts in 2026. And I believe that the market's just underpricing how much rates are going to come down. Our prediction is that housing related stocks in the housing market, we've been in a pretty much a recession in housing here in America. And I believe that changes the second half of 26. I think the housing market loosens up and we start seeing existing home sales coming off of this 30-year low and skyrocket.
Maybe we could put up a 5-year chart for United Healthcare. I mean, without commenting necessarily on United Healthcare, it's had a horrible year. There are concerns about health insurer profits. But we've seen something of a bounce off the low in UNH, just as an example. Do you think healthcare looks like a decent bet? I mean, it's been an old reliable over the years.
Yes, healthcare, I think, is a sector that will also perform well in 2026. It started its move about halfway through this year, and we think it's going to probably gain some strength as we get into 2026.
And what about your great bank stocks in America, the JP Morgans and Bank of America? Lower interest rates tend to increase their profit margins.
Yeah, I think the yield curve can shift down as a whole. Like I said, the short end of the yield curve should come down, but we are also expecting the longer end of the yield curve to come down as well. Surprisingly, but we do believe it will do that. We're going to get a new Fed chair in, Bassett, of course, at the Treasury, and Trump. They all seem to have a vested interest in getting the 10-year Treasury down, and what tools they use to do that, we don't know yet, but we do believe that is a very important subject because that is controlling a lot of interest-sensitive areas of the market, such as housing, which needs to be fixed here in the United States.
Thank you so much. I really appreciate it. Have a great weekend, Brett. Brett Ewing, Senior Financial Advisor and Chief Market Strategist at First Franklin Financial Services. Coming up, Lululemon did beat estimates in its latest quarter. The CEO is stepping down. We did see the stock jump. Shares in Lululemon are getting a lift today. The company is parting with its CEO after a miserable year for the share price. We're joined now by Bloomberg's Lindsay Biscaya. Lindsay, what's the latest, please?
Well, the latest is when you talk about the share price, it's up more than 10% last I checked. So a better day for Lululemon with this news coming out. But yeah, I mean, the CEO, Calvin McDonald, he's been the CEO since 2018 of Lululemon, announcing he's stepping down at the end of January. He's also stepping off the board of directors, and he will continue as a senior advisor until the end of March, and then he'll leave that role as well. So this is a retailer that has been struggling over the last couple of years, right? The stock has dropped more than 50% this year alone. And many economists are saying that this move of the CEO stepping down is kind of opens the door for a strategic reset from the top down that maybe the company needed. And of course, the company's been seeing slowdown in sales, particularly in the U.S. As well. More competitors are on the market now when you talk about loungewear and yoga wear, where you can think of like Alo, Nike and Skims have that big partnership. There's just more on the market. Lululemon isn't kind of the king of that that leisure wear that it used to be. So there is a succession plan in place. The CFO and the chief commercial officer will serve as interim CEOs until a new CEO is chosen. And it's not clear how long that's going to take.
Right. And it's fascinating that they are acting. The company is boosting its forecast, though, today.
They are, yeah. So there's two big pieces of news that came out this morning, and that was the second part, is that they're boosting their forecast for the year ahead. This comes after the company actually cut its fiscal year guidance twice. They also lowered their sales guidance once this year, but now saying that things are looking optimistic in the future. So the company expects net revenue to be between $10 and $11 billion. That's a growth rate of 4 to 6%. They say that improved guidance is driven mostly by international sales as well as Canadian sales, which have ticked up ever so slightly, but mostly international sales. And they also are saying they're not expecting to be hit as hard by the tariffs as they originally thought. They think there's going to be a dent in profit of about 210 million. That's compared with their initial prediction of 240 million. So definitely maybe not as bad as most were thinking. But, you know, we're getting lots of reaction today as well. I know you're going to be speaking to someone just after this, but also Chip Wilson, the former CEO and founder of the company. He's also one of the largest shareholders of the company. He's been very vocal about the leadership of Lululemon, talking about how it needs a change. And today he's coming out saying that this is only happening, the CEO only stepping down after increased pressure from him. And he wants the CEO search to be led by new independent directors with relevant expertise. So
yeah, I mean, I'm not the target market for Lululemon. They do sell stuff for men.
They do.
I have a shell from them. And one thing I love about it, it has these gigantic pockets on the inside of both sides. So you can carry a pair of gloves or something.
I mean,
it's pretty well designed.
Well, and a lot of people are saying that Lululemon has that background of designing things. They're so well designed. They have pockets where you need pockets, even for women's wear, which is something you don't see all the time. And they need to, whoever the new CEO is, really needs to get back to that and figure out where Lululemon kind of lost things and pick up on why they were so big to begin with and get back to that as well.
Lindsay, thanks very much indeed. Lindsay Biscaya. Okay, so let's get more from an analyst perspective here. We're joined by David Swartz of Morningstar Research Services. David, thanks very much indeed for joining us. What was your reaction when you heard the CEO is parting from Lululemon? Were you surprised?
Yeah, I was surprised because Calvin McDonald has been in place over 7 years, and there was no real indication that he was leaving. However, Lululemon has had a couple of tough years, and so that often will lead to a CEO change, and that's what we're seeing now. I do think that it's unfortunate that he's leaving in this way, especially with no clear succession plan in place. But sometimes a company needs a change, and Lululemon is in that place right now.
What do you think there's a prospect for a turnaround in this stock? I mean, it's up today, but still, if we look at a one-year chart, still dismal performance over the past 12 months.
Yes, I do. My fair value estimate before yesterday was $295. So I've actually thought it was undervalued at the recent prices. There was a time when I thought it was very overvalued when the stock was at its all-time high. But I do think that the decline has been overdone in that Lululemon does have an opportunity to turn around. The company is, despite its problems, the company still has great margins and high growth compared to most other apparel retailers. Most companies would love to have Lululemon's results, but they're only really poor by Lululemon's very high standards of its own past. But Lululemon is still a very strong company, very strong brand with high margins and high international growth. Certainly its growth in North America has slowed considerably, and that's been the main issue. And that was somewhat predictable because Lululemon is a much bigger company than it used to be. Right. And so there just aren't as many opportunities for new stores and for expansion in the U.S. and Canada.
They really are huge. I mean, you have been forecasting revenue of more than $10 billion US this year.
Yeah, this is a much bigger company than it used to be. So obviously it gets harder when you reach that level of size because, every metro area now in the U.S. and Canada has multiple Lululemon stores. And so there just aren't as many growth opportunities there. But Lululemon still has a lot of opportunities internationally. It's opening stores aggressively in China, and the China sales that were reported yesterday were very strong, up 46% in the quarter.
Wow.
And potentially potentially Lululemon could be opening stores in China for many years, because if you look at competitors like Nike and Adidas, they have thousands of stores in China, most of which are franchised. Lululemon is still small compared to that. And then there's a lot of other areas, like in Europe, in many countries in Western Europe, Lululemon only has a small number of stores. So there certainly could be opportunities to open stores there and other parts of the world as well. And then there's also expansion opportunities in terms of product. Lululemon, you just talked about Lululemon's growth in the men's area. It's still smaller than women's, even though we know that men spend more money than women on sportswear. So over time, the men's business could get much larger. Also, footwear remains to be seen if it's going to really work for Lululemon, but it is a big opportunity because really this athletic market is really driven by footwear, and Lululemon only has very small sales in that area. So there's a lot of opportunities still for Lululemon to become a bigger company, even bigger than it is now.
And you think the company could end up this year buying back about $1.1 billion US in stock?
Yeah, Lululemon has an extremely strong balance sheet with no debt and $1 billion in cash. So, and Lululemon generates tremendous cash flow. So the company has plenty of capacity to buy back stock, and announced yesterday that it was increasing its authorized stock buyback by another $1 billion. So, and I do think that stock buybacks are accretive at this price, and so it makes a lot of sense for Lululemon to be buying back stock aggressively. In the past, it perhaps has bought back stock at extreme prices, which maybe was not so great for shareholders. But right now, I think that Lululemon is doing the right thing by aggressively buying back stock.
And of course, Cal McDonald is exiting as CEO after a rough patch. But you say over the years, he's achieved tremendous growth in sales?
Well, yeah, Lululemon has had its best years ever since he became the CEO. Maybe that would have happened under a different CEO. That's very possible. But I have to give him a lot of credit, because for many years, Lululemon was very successful while he was guiding the company. The last couple of years have become more difficult. The company's had a number of product misses. They've had some merchandising issues where some product got to be too stale, and they've had some issues with sizing and color and things like that. There has been turnover in the design part of Lululemon. They lost their chief designer who went to Vans last year, and that's been a big problem. So that there have been some issues in the last couple of years that led to him leaving the company. But overall, you have to say he's been a very successful CEO at Lululemon. The company is much bigger now than it was when he came in, and their international expansion is really progressing well.
It's interesting. China is about 18% of their total sales. And as you say, that's a vast market, and they still seem to have momentum there.
Yeah, I mean, potentially Lululemon could be growing in China for many, many years. Yoga is big there. There's growing interest in sportswear in China. For example, marathons in China now become huge. Thousands and thousands of people run marathons in China. All this has really been happening just in the last several years. It's really growing rapidly. And Lululemon is in position to grow there. There isn't as much competition as there is in Europe and North America and China. And so there is a lot of potential there for it to be seen as a luxury brand, just as it is in the United States.
The Randall Koenig is an analyst at Jefferies who has been a long-time skeptic. He's now gone to a hold today. He says, this could point to a change, but he reckons that things could get worse before they get better, that Lulu still has a lot of things to work out. So could this be a bumpy stock to hold for the next while?
The fourth quarter that we're in right now is likely to be kind of a difficult one, and probably there's going to be some slowness into 2026 as well. In my model, I really have the turnaround coming in 2027 and 2028, when Lululemon have a lot of new products on the market, and they will have sold through a lot of the older products that right now they're having to discount to really move. So that will take time. Turnarounds in this industry do not happen overnight. They often will take 2+ years. But I definitely think that Lululemon can do it. The company's brand, I think, is still very popular. And I think that their customers will come back when Lululemon gives them products that they want to buy.
Would they be better to maybe just say the heck with it and get out of things like footwear or pull back in men's?
No, I don't think so at all, because I think there's really an opportunity there. If you look at other sportswear companies, they're really driven by footwear. So Lululemon is primarily an apparel company that only sells a small number of shoes, but potentially that could be a much larger business. There's no reason to think that it couldn't be. We've seen other shoe companies in recent years, like On and Hoka, that have come on very strong in a relatively short period of time. So, if they can do it, then so can Lululemon. It's a very large market, and there's plenty of room for many successful companies in that space.
Thank you very much, David, as ever.
Thank you.
David Schwartz of Morningstar. We've lots more. Trading Day will be right back. Rivian is making a high-stakes bet that its own AI chip and a new LiDAR system will power its path to driverless autonomy. Bloomberg TV's Ed Ludlow reports.
Rivian's developed its own artificial intelligence chip for its future cars. That gamble might pave the way to fully autonomous driving. A lot of the tech world imagines a future where we don't own cars at all. We're talking about fleets of robo-taxis that are summoned through an app, maybe no steering wheel or driver controls at all. But Rivian's in the camp that does see people owning their own cars in the future and being willing to pay top dollar for a software platform that allows the car to drive itself. If this idea seems familiar, Tesla has been selling a version of it for years. Full self-driving supervised is not technically full autonomy if you read the fine print, but it can get you from point A to point B without needing to put your hands on the steering wheel. Rivian's path to autonomy is rooted in two big bets. The first, a custom AI chip developed in-house, which marks a big break from NVIDIA.
This is a RAP1 chip. It's a multi-chip module. In the middle is a Rivian-designed custom silicon surrounded by memory on two sides. The decision to build it in-house was based on a very rigorous analysis of the benefits we could come, and those benefits are velocity, or ability to get to market very quickly with it, performance, and cost.
The second, a major change in how Rivian vehicles see the world. The next generation Rivian R2 will have indented LiDAR sensors in it.
It's not just about the compute, it's also about the sensors, and it's about how they all come together.
This is Rivian Mark 1.
What the Gen 3 architecture does with compute levels that are dramatically expanded. So just to put some numbers to this, at the platform level, 1,600 sparse tops. Right. We can process 5 billion pixels per second, beautifully integrated LiDAR. That raises the ceiling to allow us to take your eyes off the road.
This will cause some debate. Tesla vehicles only use cameras as sensors for their systems, and what Elon Musk's company has always argued is that other sensors like LiDAR or radar are too expensive to scale. Until now, Rivian didn't really have an autonomous system. It had advanced driver assistance tools powered by cameras and radar. And Rivian used NVIDIA chips as the brain in the vehicle to interpret the world around it. Rivian says its new AI model will keep improving those older cars too, eventually adding capabilities like hands-off point-to-point driving. Rivian doing its own chip and ditching NVIDIA is a surprise.
On the Rivian processor side, this represents a significant cost savings to us. There is a lot of margin, of course, in the semiconductor space, and working directly with TSMC, we have a great relationship with them.
The new hardware is the unlock. It should allow Rivian to go from that driver assistance software in its existing lineup to true autonomy in the next Gen R2.
And the next big step is personal level 4. And what I mean is the vehicle can operate empty. It can operate without anyone in the driver's seat. It can pick your kids up from school. It can drop you at the airport. It's a complete shift in how we think about the vehicle experience.
Looking back, this was the company that pulled off the 6th largest IPO in US history, and it was first to market with full-size battery electric pickups and SUVs, beating out Tesla, Ford, and General Motors. But today, Rivian's struggling with the basics. Production of its EVs hasn't really scaled. Rivian's sole plant in Illinois is capable of building 250,000 units a year, but in 2025, it probably won't hit 50,000. The truest representation of that struggle, the stock is at a fraction of its peak. Right now in the world of tech, you have to have something to say about AI, and Rivian is diving deep into autonomy to appease its investors. An AI chip, LiDAR, and a large driving model. Right now, it's a promise from Rivian that their next generation vehicles will have genuine autonomous capabilities.
We're going to have more chips after this. Shares in Broadcom down double digits today. Investors are worried about slower than expected growth in AI orders and also a squeeze on profitability. Shares in Lululemon bouncing off the bottom today after a miserable year, up around 11%. The company's latest results topped expectations. Lulu increased its full-year revenue forecast and said the CEO, Calvin McDonald, is stepping down at the end of January. Some analysts see the move as positive after the company posted disappointing sales. Athabasca Oil is one of the biggest decliners in Toronto today. It provided a 2026 production outlook that disappointed some investors. It expects average output next year of up to 39,000 barrels per day, and that fell short of analyst estimates. The company has also earmarked $273 million in spending for its thermal oil division, but will lower capital spending at its Duvernay assets. Costco is out with its latest results, and the retail giant posted higher profit, and it saw total revenue jump more than 8%, beating estimates. Same-store sales across Canada, the US, and international markets were higher than expectations. Costco says the results were helped by a record-breaking Black Friday for its US e-commerce unit. And there's a look at the TSX Composite. It did get to a new all-time high earlier today, but down slightly. And let's check out the US market. Selling in some of the big tech stocks, helping to drag down the US market today. So Broadcom's backlog, particularly in AI, disappointed investors, and there are concerns over its profit margins. But our guest says a decline in the shares today is a buying opportunity, and he has raised his price target on the chip supplier from $365 US to $480. We're joined by William Kerwin, Senior Equity Analyst at Morningstar Research. William, thanks very much indeed. Just remind us, would you, what is Broadcom's part in the AI world? They're a chip supplier, and they are in some ways a rival to NVIDIA.
Yes, thanks for having me on, and I appreciate your Christmas tie. So Broadcom's role is in AI semiconductors, and they are in part a competitor to NVIDIA and in part a complementary player to NVIDIA. So right. What Broadcom produces are what we call custom AI XPUs versus a generalized solution like a GPU from NVIDIA. These are customized chips tailored to a specific application or a specific customer. So Google is a common example. Their TPU is customized to their internal workloads like Google Search and training the Google Gemini model. So they have 5 marquee customers in this business, and they make chips customized to each of those customers. Now, in addition to those compute chips, they also make connectivity chips, what we call networking, and they supply those across the board to really every AI customer you can imagine. But the focus of the call and the share reaction today is really in that XPU business.
And does it look like they have slowing momentum there?
Not in the slightest, in our view. We loved the results last night, and we are increasingly bullish on the name. Rather than any slowdown in this demand, we are seeing an acceleration in Broadcom's demand through the course of fiscal 2026, and we think into fiscal 2027. And there are 3 primary drivers of this. So one is their existing customers are seeing rising demand, and Google is chief among these. There's been a lot of bullish narrative in the market over the past month on the latest TPU for Google. This is a version of an XPU, which trained their Gemini 3 model and is now actually being rented out by competitors like Meta and like Anthropic because it's so strong. So that existing customer demand is rising. We're also seeing a layering in of new customers like Anthropic and like a fifth unnamed customer that was announced last night, adding to a really what we expect to be a surge in second half of 2026 revenue. So far from slowing down, it is accelerating.
Why are investors worried then, William? Is it simply because they're nervous with the huge run up in the stock for, I think it's 3 years now?
That's probably the background to all of this. There were some nitpicks you could make on the call, so to speak. So these custom XPUs are actually gross margin dilutive, and we think that may have spooked investors a little bit. But we don't worry about that because even if they're gross margin dilutive, the amount of volume that Broadcom is able to sell of these makes them operating margin accretive and earnings accretive. Now, you had mentioned the backlog at the outset of this segment. That was a concern, too, because we think that investors are comparing that to NVIDIA's $500 billion backlog, and Broadcom's, in relative speak, was a measly $73 billion. But these are apples and oranges in our view. The $73 billion number that Broadcom threw out was actually higher than we were estimating, and we think there will be upside there because that was a number given for the next 18 months. We expect new orders to come in over that time. These are generally short lead times, and so we actually see that as a bit of a floor for what they can do over that period.
What about their balance sheet? Have they racked up lots of debt like Oracle?
Not to the extent that Oracle has. Now, Broadcom is a serial acquirer, and 2 years ago, you may remember the massive VMware acquisition that the company conducted. They took out a significant amount of debt following that acquisition and are continuing to pay it down. But simply put, this company is a prolific generator of cash flow, and quickly, even only a year to 18 months out from closing that acquisition, we think they've successfully delevered less than 2 times leverage now, and they are printing $40 billion in cash flow by our forecast over the coming year. So we don't worry about the balance sheet at all. We think it's in pristine shape.
What about generally AI? It's a very broad question, but do you think there's going to be tears ahead and broken dreams in these stocks? Do you think that the whole sector over the next few months is going to be under pressure?
It's all about expectation setting. We really believe that AI is a long-term trend that will benefit this AI infrastructure and tech hardware over the long term. Now, that is not to say that that's going to be a linear progression up and to the right. And so I do expect there to be fits and starts during this demand. But in the short term, meaning the next 1 to 2 years, everything is highly supply constrained in this environment. And that can be viewed as a negative because the likes of NVIDIA, the likes of other AI infrastructure hardware players could be shipping more today based purely on the demand, but they're being constrained by the supply. But that can also be viewed as a good thing because what that means is that many orders for these chip makers or other infrastructure players are already booked through the course of the next 12 months. And that provides some nice certainty in the market that this revenue is going to manifest. Now, at some point, potentially in the next 3 to 5 years over that medium-term period, we would expect there to potentially be a correction or a normalization or maybe a slowdown in this demand. But we would view that as a short-term, bumpy dynamic over the course towards this long-term positive growth that we expect.
William, we better leave it there. Just remind us, though, one last thing. Is there still an iceberg for AI investors? I'm wondering about these reports we've seen. And of course, it's such early days that corporate customers are not realizing the extra revenue and or savings that they hope for from AI investments.
Well, that is the trillion-dollar question. We think at very least in the next 1 to 3 years, there's enough investor appetite from the investors in the spenders on AI to continue spending in the hopes that that revenue and those cost savings come out. And if that doesn't happen in the next 3 years, then we may be having a different conversation. But we believe it'll come. It may take longer than investors currently want. And that's what I was talking about with that potential for a correction or normalization at some point down the line in the next 5 years.
William, thank you very much indeed. Really appreciate it. William Kerwin, Senior Equity Analyst at Morningstar Research. After the break, Bloomberg's Christine Dobby is back with her weekly newsletter, Bay Street Edition. You won't want to miss it. And she's talking about this pretty alarming so-called Trump doctrine. Bloomberg Canadian finance reporter Christine Dobby joins us now, as she does every Friday when she can spare the time. Christine writes the Bay Street Edition, an always readable weekly newsletter. Christine, you have a great topic here. It is pretty disturbing as well. So we've got this new Trump doctrine. Of course, there was the Monroe Doctrine, a former president essentially telling European powers, don't mess in our hemisphere, we call the shots. But this Trump doctrine goes much further?
Yes, Andy. So, this sort of came out a bit quietly at the end of November, and it wasn't really noticed in Canada until about a week and a half ago. And what it is formally is the U.S. National Security Strategy. And there's no specific mention of Canada when it comes to the Trump doctrine, but there's a whole section on the Western Hemisphere, and its subtitle is The Trump Corollary to the Monroe Doctrine. And as you referenced, the Monroe Doctrine was this 19th century policy that could be boiled down to the U.S. saying essentially, stay out of the Western Hemisphere to Europe. And the Trump doctrine, if you want to call it that, is a version of that where it envisions the United States being the preeminent power in the Western Hemisphere, and it sees itself doing that through control of assets like ports and infrastructure and other strategic assets. And what this document really lays out is the U.S. having this control in parts of the world through the use of its technology and its companies, as well as, its military might. But it really is an economic imperialistic vision of the world with the U.S. at the center of it.
I mean, it's pretty tough, isn't it, for the Prime Minister? He did back down on that digital services tax. And he's talked about elbows up, etc. But in some ways, there's only so far he dares to push the president.
Absolutely. I mean, and this is going to be a big issue as we come into the next year. As we know, the main topic on everyone's minds is going to be the renegotiation of CUSMA, what's going to happen with that free trade agreement. And one thing that some critics were calling for this week is for Canada to get more aggressive about things like protecting its data sovereignty and putting legal frameworks in place to, assert Canadian control and ownership over data and digital infrastructure, and to put some ground rules around AI in Canada. And that sounds a little bit wonky, but these are really important emerging assets and things that we really need to be thinking about.
You're also looking at the prospects for M&A deals in Canada. Of course, that can contribute nicely to bankers' bonuses, and they have been pretty good over the past year.
Yes, we like to talk about bankers' bonuses every week around here. The numbers from a PwC report this week showed that the value of M&A deals was pretty steady this year and up in the last 2 quarters. And it predicted that there would be kind of a steady stream of deals going ahead into 2026.
Yeah, I mean, it is interesting that it's a variable cost for the banks, but that's the model, isn't it? To some extent, certainly in the investment business, it's eat what you kill. In other words, if you don't bring in business, you don't get paid.
Yeah. Yeah, and that's what, as we were talking a lot about last week during the bank earnings, they all did so well on capital markets, but that you can never totally count on that. It's very contingent on that landscape for deals, as well as, activity in the markets in general.
Christine, thank you very much indeed. Have a great weekend. Christine Dobby.
Thanks, Andy. And I wanted to compliment you on your tie, your festive tie.
It's attracting a lot of attention. Thank you very much indeed. I have mixed feelings about Christmas. I love the goodwill and the food, but sitting in overheated rooms too long with other people, that gets to me anyway. But I'm just a cranky old fella.
Okay. Wear the tie.
Thank you very much, Christine Dobby of Bloomberg. Okay, we have lots more ahead. Of course, the so-called Trump doctrine it's a pretty alarming declaration. The CRA has apparently improved call answer rates for customers, and it is increasing online options. We'll get more after the break. Canada Revenue Agency has apparently improved call answer rates, and it is offering more online options. But there's continued concern, though, over whether these gains can last. CTV's Abigail Beeman filed this report.
Very scary when you think that you might lose all your teeth.
Dealing with her husband's dental emergency, Zuli says it's been a nightmare trying to reach the CRA for help from the Canadian Dental Care Plan.
It's been quite an ordeal. It's been 2 weeks of tears.
We're very proud of the work that our teams have managed to accomplish.
After the 100-day service improvement plan, proud the number of calls answered went from just 35% to hit the goal of more than 70%.
We will never be in a position to answer 100% of the phone calls that we receive at the agency.
At 30 million calls a year, 300,000 a day during the spring tax filing season, the CRA calls it unsustainable.
When it comes to contact center operations that are being operated in a very fiscally responsible and somewhat restrained way.
And in the face of government-wide tightening, a boost to 4,500 call center employees at tax time is temporary, with cuts possible.
We're not in a position to tell you right now, that whether there are cuts planned and when they might be.
They are investing where we have massive problems.
The union head believes call center staff are safe for now, but calls improvements in the 100-day plan a Band-Aid solution.
The improvement also stems from the fact that we're at the low season. We're not in a tax season. So we need a lot more help.
It's not as easy as just throwing people at problems. I don't believe in that. I believe in saying, what do we need to offer the proper service to Canadians? We need to make sure their phones are answered on a timely basis, 1. 2, we need to give Canadians options, online digitalization.
As an example of increased online options, Canadians locked out of their CRA account can now access them digitally, diverting as many as 300,000 calls a year. The union says the real test will be what happens on day 101 after the plan and beyond.
Okay, let's have a look at the markets. The TSX Composite did get to that record high, now trading slightly down, and US stocks are down as well, with that sell-off today in Broadcom, and it has spilled over into some other AI-related names. In Toronto, though, we are... Oh, there's Broadcom. Thank you, Control Room. In Toronto, we are seeing a surge right now in some of the cannabis stocks. Canopy Growth, Weed, Curaleaf, CURA, Tilray's on fire, so is Kronos, all sharply up. That's after the Washington Post reported that US President Donald Trump is interested in moving cannabis to a fairly lax designation of Schedule 3. But, I mean, we've seen this movie before. There's been talk of, decriminalization and liberalization in Washington, and it hasn't in the past come to anything. I mean, there have been moves, I'm not denying that. But it's always glacial in Washington. Let's have a look at Celestica here, because it has seen some selling today, as you might expect, when there are concerns, jitters, over the growth of... let's have a look at Celestica, because it's been a Canadian flag bearer. It's been a great stock to own. Look at that, in the past 12 months, up more than threefold, but it is down right now. They are seen as a big winner in supplying AI equipment, but any jitters there tend to get reflected in Celestica stock. Thanks very much for watching Trading Day and have a great weekend.